Hey everyone. Welcome back to Insurance World TV, where we break down complex financial topics into simple, actionable advice. In our continuing series on bid bonds, we answer the age-old question, which provider should you choose for your next tender, a bank or an insurance company? Bid bonds are essential in most tendering processes, whether you're in construction, procurement, or public projects. But when it comes to choosing between getting your bond from a bank or an insurance company, things can get a little tricky. Each option has its pros and cons that can impact your chances of winning a contract, such as the cost of the bond and even the timeline for your tender submission. In this video, we'll break down the advantages and disadvantages of using a bank versus an insurance company as your bid bond provider. By the end of this video, you'll have all the information you need to make the right choice for your next tender. Whether you're looking for credibility, faster processing, or better pricing, stick around, and let's find out which option fits your business needs best. So, let's jump right in and explore the differences between these two major providers. Don't forget to hit the subscribe button if you haven't already for more helpful insights on finance and tendering. Topic 1. Insurance companies' bid bonds/insurance guarantees. Let's look at the advantages and disadvantages of using an insurance company as a bid bond provider. Subtopic 1. Advantages of using insurance bid bonds. The first advantage is streamlined process. Insurance companies often have a more streamlined and quicker process for issuing bid bonds compared to banks. This can be crucial when working with tight tender deadlines, ensuring you don't miss out on submitting your bid. Advantage number 2. Industry expertise. Many insurance companies specialize in providing bonds for specific industries such as construction or procurement. This industry knowledge allows them to better understand the risks involved, making the process smoother for bidders. Number 3. Flexibility in requirements. Insurance companies typically require less collateral compared to banks, especially if you have an existing relationship with them. They may also offer flexible options for small and medium-sized businesses that might struggle with the stricter terms imposed by banks. Number 4. Competitive pricing. Insurance companies often provide bid bonds at more competitive rates, especially if you bundle other services like performance bonds or general liability insurance. Number 5. Ongoing relationship. If you regularly work with the same insurance company, building a relationship can offer additional benefits such as faster approvals and potential discounts on future bonds. Now, let's look at the disadvantages of obtaining bid bonds from an insurance company. 1. Limited financial capacity. Some insurance companies may have a lower financial capacity compared to larger banks. This could be a concern for clients if the bond value is high, as the client needs assurance that the provider can cover any claims. 2. Less stringent credit requirements. While flexibility can be beneficial, some clients may view insurance companies as less stringent in their risk assessments compared to banks. This could make the client more cautious about accepting a bond from an insurer, especially in high-value or sensitive projects. 3. Higher risk premiums. Depending on the perceived risk of the project, insurance companies may charge higher premiums for bid bonds, particularly for bidders with less established credit or for high-risk contracts. 5. May not be accepted by all clients. Some clients, particularly those in highly regulated sectors or in certain government contracts, may prefer or even mandate bonds from a bank or a larger financial institution over an insurance company. 6. Focus on specific sectors. While insurance companies may have expertise in specific sectors, they may not have the same breadth of experience or offerings for projects outside those industries. If your business spans multiple industries, this could limit your options. Using an insurance company for a bid bond can be a great option, especially for bidders seeking a more streamlined process with lower collateral requirements, but it's important to weigh the potential downsides based on the project and the client's preferences. Topic 2: Bank bid bonds. Let's now turn our attention to bank bid bonds/bank guarantees. There are several advantages and disadvantages of using banks as bid bond providers. Here are a few that we have talked about. Advantages. 1. High credibility. Banks are often seen as highly credible institutions with significant financial stability. Clients, the entities offering tenders, tend to have more confidence in bid bonds issued by banks, especially for large or high-stakes projects. 2. Strong financial capacity. Banks usually have the financial strength to back large bid bonds, making them a preferred option for high-value tenders. Clients may feel more secure knowing that a reputable bank is backing the bidder's bond. 3. Regulatory compliance. Banks are heavily regulated, which adds an extra layer of trust. Many government tenders and large corporations often mandate bid bonds from banks due to their strict compliance with financial regulations and due diligence processes. 4. Reputation enhancement. For bidders, obtaining a bid bond from a bank can enhance their reputation in the eyes of the client. It signals financial stability, which can make your bid more attractive compared to competitors using less well-known providers. 5. Lower risk premiums. Due to the bank's strong financial backing, bid bonds from banks may come with lower risk premiums, especially for established companies with a solid credit history. Disadvantages. 1. Lengthy approval process. Banks often have more stringent and time-consuming approval processes. They require extensive documentation and credit checks, which can delay the bid submission if you're working with tight deadlines. 2. High collateral requirements. Banks generally demand higher collateral or personal guarantees before issuing bid bonds, especially for smaller businesses or first-time bidders. This can be a major barrier for businesses that don't have significant assets to pledge. 3. Less flexibility. Compared to insurance companies and surety companies, banks tend to be more rigid in their requirements and terms. They often have less room for negotiation when it comes to bond amounts, collateral, and other conditions. 4. Higher costs for some bidders. For smaller businesses or companies with less established credit histories, banks might charge higher fees or demand higher collateral, making bid bonds more costly compared to using insurance or surety companies. 5. Complex documentation. Banks may require a great deal of financial information, including balance sheets, income statements, and other credit documentation. The paperwork can be complex and overwhelming, especially for smaller companies or new bidders. Using a bank as a bid bond provider offers a great deal of credibility and financial security, which is highly valued by clients, especially for large-scale projects. However, the more rigid processes, higher collateral demands, and slower approval times may make it a less ideal option for smaller or newer businesses looking for quick, flexible solutions. In short, choosing between a bank and an insurance company for a bid bond depends on your project size, business needs, and client preferences. Banks offer greater credibility and financial security, ideal for large tenders, but have more rigid processes and higher collateral requirements. Insurance companies provide faster, more flexible, and cost-effective solutions with lower collateral, though their financial capacity may be limited and less preferred by some clients. Weighing these factors will help you pick the best option for your next bid. The end. See you in our next video.